Welcome to the Midweek Market Update, where I do a technical analysis and give you my thoughts on SPY the Qs and IWM. This week, we're also going to take a brief tour through our core list of companies here, and I've also got 2 additional trade ideas to share with you towards the end of the video, so definitely stay tuned for that. Let's kick off our S&P analysis with the sectors as we always do, looking at who was leading, who was losing, and where was the weight. The builders led the pack today, but only because they were down the least, only down 0.01%. The XLRE for real estate really took a beating today, down at the bottom of the barrel here, down 3.25%. As we know, neither of those 2 sectors make up a significant weighting in our S&P, so what does? Certainly our XLK, still skewed down towards the bottom of the barrel, down 3.07%. We know that's the heaviest weighted sector of them all. The XLF for financials, second heaviest weighted sector, more middling here, but still down nonetheless, down 1.16%, and there has been a significant rotation out of tech and into financials as rates have skyrocketed. We'll talk about that in a second here. And then our XLV for the third heaviest weighted sector, down 0.71%. Before we get into these charts and take a look at what's going on from the technical perspective, I would also point out that the only green we saw on our list today was as measured from today's open, and the 2 sectors we saw the green in were the utilities as well as the consumer staples, both very defensive sectors, not really going to help us out a whole lot as we're seeing a very big pullback in the S&P 500. So let's get into those charts now. XLK to kick things off here. What I would point out is that the uptrend is starting to slow down a little bit. It's getting a little bit more volatile. In here, you can certainly see how clean it was. And again, we're not expecting that to last forever. It's fairly unsustainable. But just look at what's going on here. We have a move higher, nearly a 100% retracement, move higher, 100% retracement, move higher. Will this be yet again another 100% retracement into 164? I can't say for certain, but certainly, we are looking at a close underneath the daily 50 SMA. This is the only saving grace that we have right now for the potential for a higher low. If that happens, again, don't get me wrong, we will have an uptrend intact. We have low, higher low, potential for a higher low. We also have high, higher high, and higher high. So it's not like the chart is completely destroyed right now. It's not like it's posing a huge threat to the S&P 500, but what it is doing is starting to say, hey, I'm not messing around. If I come back down into 164, you better watch out, because at that point we would have 1, 2, 3, 4 interactions at that level in a very short proximity of time. Each time after making a new higher high, that's not really what you want to be seeing in your XLK here. I would start to classify that as a flush point, and it could start to shift the trend here from the daily perspective if we lose 164. So again, the chart's not destroyed as of right now. There's still potential for a higher low here, but really start to keep a closer eye on it. Next up, we'll talk about the XLF for financials here. There we go. And obviously with rates booming, these guys have really benefited. What you'll notice is we do have a new all-time high. That's a higher high from what we've had in this most recent trend higher. And we also get a break of that significant resistance trend line here. But what I would point out is notice that as this is pulling back and as the XLK is pulling back as well, the relative strength in financials alone is not enough to keep your S&P 500 afloat. So if this continues to pull back and your XLK continues to see rotation out of that sector, then I would really watch out for your S&P to continue lower. The pullback targets in your XLF would be the gap fill for a gap fill reversal, something like that for a higher low off of 39.66. If that doesn't happen, the line in the sand has to be the top end of the range and where the breakout really stemmed from at 39.25. Those are really important numbers here in your XLF. If it does fall back down in here, sort of kiss your S&P 500 goodbye. Without the help of the XLK and the XLF working together, I don't really foresee the S&P moving significantly higher. Now again, don't take that as being immediately bearish. That there's some things that have to happen before we move to the bearish slant, but it's just one possibility to consider, right? As of right now, we are still significantly higher above that 39.25. Just keep these scenarios in mind if the sectors start to deteriorate. While we're talking about financial things, let's take a look at the TNX for our 10-year rate. And zooming in on this, what you'll notice, and again, we sort of alluded to this, big move to the upside here, coming from 1.5 up to about 1.7, big triple top now on the daily here. Traditionally, we don't really look at rates through the lens of technical analysis, but you could just say maybe it's time for them to cool off a little bit up here, noting that we've resisted in the past. That would be valid. But the one thing I would counter that with is that because of what we learned from the FOMC minutes today, is that we're sort of on track for the rates to rise as expected. Those benchmarks that we need to see hit are likely going to be hit. That's what sort of came out of the FOMC meeting minutes. Now, I'm not here to argue whether or not the Fed is doing the right thing or the wrong thing. I'm just here to tell you what they said and how the market's reacting. I prefer not to be biased in that sort of view of the market because I don't want to be on the wrong side of that, right? So as rates are going to continue to rise higher, if they're going to continue to rise higher up and over 1.7, then look for your financials to continue to show relative strength and it to really start hurting and continue to hurt your XLK. As we mentioned, the XLF is not going to be enough alone to keep your S&P 500 afloat. So I would imagine if these continue to scream higher, that the S&P is not going to bode so well. If these cool off, I think that's an ideal scenario for the S&P 500 continuing to make its move back towards those all-time highs. Rates sort of stabilize, the XLF consolidates, maybe the XLK stabilizes as well, and can even get a little bit of an uptick knowing what's in store and where rates are kind of hanging out. If these collapse, obviously that's going to be a good thing for your XLK, and your XLF will hurt a little bit. Maybe it comes back down to that breakout point, that 39.25. That's really the area to watch out for. If these totally collapse back down to here, I would imagine that that's not going to be good at all for your XLF. And then any subsequent pullbacks in your XLK are really going to damage the S&P, right? So no matter how you slice the cake, a directional move in rates is probably not the best thing for the S&P 500. If they are to cool off and sort of put in a period of consolidation like what we saw in here as the market digests that, maybe that would be the optimal scenario inside of rates here. With that out of the way, let's wrap up our sectors and talk about the XLV for healthcare. Again, this is the third heaviest weight. It's been making a very impressive move off of the support trendline, don't get me wrong, but this pullback is starting to become a little bit aggressive. In an ideal world, we would have held up here at the 137 for a higher low, done something like this. We would have used that as the prior low and things are fine. We're still remaining in the uptrend. Based on the aggressive nature of the past 3 days and how we've closed today's session, I wouldn't be surprised if we come in for an equal low, but do be on the lookout for super support with that daily 50 SMA. I think the spotlight really is going to remain on the XLK and the XLF. It doesn't mean, take your eye off of the XLV, but it's really taking a back seat to the show right now in those two sectors we just talked about, the push and pull with rates. So again, something to monitor here, but the fireworks are really going to happen in those other two sectors that we've talked about so far. As long as we're above the 50 SMA, I would say things are fine in your XLV. If we start breaking down, it's simply all about the support trendline, which depending on time of week could be 132.50 or 133. Obviously on an uptick, that bodes well for your S&P 500. Let's talk about volatility now, coming on over to the VIX. And what we'll notice here is that we're simply coming into that volatility trigger event, right? So 2050 is the number to watch. We made a move from the midpoint of the range right up to that level. Now, it hasn't broken out completely yet in the VIX. However, if it does, we know we're looking for buyable pullbacks as we're likely getting a bit of an overreaction. If the TNX continues higher, right, on that directional move, I wouldn't be surprised if the VIX breaches 2050 to the upside. Let's take a look one more level behind the curtain at the VVIX, volatility of the volatility index. And this is sort of signaling the same thing. It's saying, hey, we're kind of right on the cusp of a volatility event. We know that number is 120. And again, that's kind of right where we've closed. If the VIX remains under 2050, but this starts to pop above, then I would be, looking for the advanced heads up there that maybe your S&P sees a bit of a bigger downswing and the VIX takes out 2050 to the upside. So that's how those two work in conjunction. Let's get on over to the S&P daily chart now and talk about tradable levels into the remainder of the week. I mean, clearly big pullback on today's session. We're clearly falling out of this bull flag here. However, there's been a lot of value that was built up here. We'll see that on the profile in just a second. And I'm not sure if we're going to get a little bit of a dead cat bounce. To me, it would be a reasonable thing to expect based on what we'll see in the profile in just a second and where value is, as well as what's going on with internals in just a second. But in terms of levels to watch out for, we're certainly back down underneath this breakout point here around 470.40, 470.50 if you like nice round numbers. So that's kind of concerning, right? Is this nothing more than a fake break going to come back down and really make that rotation towards the lows and the gap fill here, the support trend line from the weekly? Maybe, okay? And again, I do think that there is potential for a dead cat bounce before that would unfold. So let's talk about that now. Let's go on over to our internal screen. If you're not familiar with this screen, top right-hand corner will tell you what this is, how you can set it up, and how it'll help you make better intraday trading decisions. On Monday and Tuesday, we really saw nothing more than just consolidation. We saw a day up, a day down, nothing too concerning. And the internals would support really just balance, right? Neutral volume here, neutral sort of advanced decliner, and very, very, very muted cumulative reads in the tick. No big deal. That's what we would expect on a back and forth day. However, on today's trending day, this is where we can read into it a little bit more and confirm the activity to the downside. Notice that we essentially fell off of a cliff in the volume read, coming from net 100 million to the upside to net 385 million to the downside. So total, that's what, minus 485 million to the downside volume in effect from the highs here. That's fairly significant. Generally, what we look for is the 300 million mark, either positive or negative, and we certainly breached that on today's session. In terms of the advanced decliner, again, sort of neutral in the morning and really falling apart into the afternoon as things started pulling back. The area where, again, it would start to indicate to me at least that maybe we see some sort of dead cat bounce is just the amount of emotional activity we see in the tick towards the end of the day. Generally speaking, stronger selling is not going to occur on minus 1,000 ticks sustained into the end of the day. Sure, we'll have a bearish skew in the tick, don't get me wrong. It's like a majority of the daily bars will be under the zero line, but what you don't want to see is all of those ticks underneath the negative 1,000 mark. Again, that's just indicating pure emotion. Market trends are not sustained on emotion, at least to the downside, right? So because of that, yeah, maybe there is a little bit of a dead cat bounce. The next sort of supporting piece of evidence for that would be the market profile. If you're not familiar with this, yet again, I've got another video for you, top right-hand corner. We'll describe what this is and some of the terms I'm about to use. For now, what I would point out is where is the point of control, right? We've had this very, very long area of balance here. That's what we talked about from the flag consolidation on the SPY daily. And what you'll notice is that today's point of control, this little green dash over here, maybe it looks yellow to you, that's at the high of the day. It's not like it was skewed down here towards the lows on that massive sell-off. And that's just the fairest price to do business on today's session, smack in the midpoint of this overall, multi-day balance area. So to me, that would indicate that maybe sellers got a little bit too far ahead of themselves. We need to correct some of that inventory that, again, just got too short. You would call that short in the hole, right? So let's go ahead and take a closer look at today's session. Certainly multiple areas of single prints. You should treat each area of single prints as a gap, essentially very low volume there, very low liquidity. We should move through it with ease. Here's a big one right here from 47.60 down to 47, let's call it 47, kind of smack in the middle. Next one would be the midpoint, half back of today's range. That's going to be roughly 47.40 down to 47.27. And then underneath that, this is pretty choppy in here, maybe up and over the overnight low or high, you do get another set of single prints here, 4,700 up to 47.07. So roughly three areas of single prints to contend with. Again, I would just point out the thin nature of the volume in this section. Whoop, there we go. Let's clean that up. Try that again. Thin nature of the volume as we were making that descent lower, and all the value on the day is, again, significantly higher. It's not to guarantee that there is some sort of dead cat bounce, but it's just some information to take in here, and you shouldn't be caught off guard, right? If some of this inventory has to correct, and we do move through this with relative ease. So that's what I'm thinking about here from the profile perspective. The other thing you could start to do is classify this as a bit of a spike. It's not a perfect spike, but if we accept within the spike, obviously that's a more neutral scenario. We're looking for two-sided balance to continue in here. If we accept underneath the spike, so today's lows, that's a bearish outcome, meaning we need to auction lower, find new buyers at lower levels. There's no one here essentially, and obviously accepting above, most bullish outcome, getting us closer to that point of control, which should act as the target. Let me give you a number on that. That's going to be 47.80, we'll call it, just for round number's sake. So that's the profile in a nutshell. Again, indicating to me at least that value is still higher. We might be getting a little bit ahead of ourselves to the sell side. Let's go back on over to the platform here, round out our broad market. I do briefly want to talk about the S&P levels on the daily here, just because we sort of, we talked about the potential for a rebound. I want to discuss where the numbers will be, right? So we do have this gap, which we've closed in underneath. I think the downside line in the sand is here at the 466.30, coming from that FOMC spike from in here. We discussed that in prior Wednesday videos, but it's also going to be 50 SMA, right? So to me, that super support is fairly important. We know that the S&P has liked to support at the 50 SMA over, the recent history at least. You can see in here once, twice, three times, 4, 5, 6, not really 7 in here, but ultimately 7 maybe there. This is a sloppy 8, right? So the 50 SMA is fairly important on our S&P 500 daily. Keep that in mind as we move forward. If we are to take it out, that's where I would start to get concerned about a rotation to the support trend line from the weekly perspective. And again, these can be short-term scalps to the downside, that's fine, But overall in the S&P 500, things don't dramatically change. Like today's candle would not indicate that we're going to make it to like 400 or 425. The only way you get that bearish in your S&P 500 is if the weekly support trendline actually starts to break down, which as of right now would be closer to about 455. So please don't get overly aggressive to the downside just because we have one day of sell side activity based on some FOMC catalysts. Again, there's a lot of emotion wrapped up in the move today. Just don't get ahead of yourselves, okay? Please, that's all I'm asking based on the daily time frame chart. Let's talk about the QQQ now. This one, a little bit of relative weakness in this name, clearly not giving ourselves a new higher high in here. So we do get something that looks like that. Let's draw in a resistance trend line here. Grabbing that tool, coming in, and there we go. And firmly breaking down as well, right? It's no surprise the money's been flowing out. A more aggressive day down on the Tuesday session as well. Certainly well beneath our 50 SMA and underneath the base of the FOMC spike from right around in here. To me, based on the ramping up in volume as well, and we did see that on the S&P 500, but the relatively weak close, I would start looking for a 100% retracement into that 378.50. And just to take out the Fibonacci's, and we'll go back to the S&P just to take a look because I want to stay consistent here. In terms of Fibonacci closes, we're back down underneath our 61.8. As we know, candle closes under that level dramatically increase the odds that we get a 100% retracement. So that's what I would watch out for here. Just like in your S&P 500, you're not going to get overly aggressive to the downside unless this support trend line does start to break down. And just to give you an idea of where that's coming from, you can just use these two data points. We have March as well as May in here. We sort of get another point in October as well. That's where the support trend line's coming from, right? If that breaks, sure, start to get a little bit more bearish, probably 350 on the horizon from the October low. But again, until we get there and break, don't just assume that the QQQ will completely fall apart as we head into 2022. So let's zoom back in, and actually we'll go back over to the S&P 500. Sorry to throw you off with so many switches here, but I do want to stay consistent with that sort of Fibonacci analysis coming in. And what you'll notice here is that we're right at the 38.2, which is a much stronger Fibonacci number to be paying attention to. This pullback could ultimately constitute bull flag consolidation here, looking like this from the daily time frame chart if we were to turn around and catch ourselves immediately here for a higher low. Now, it's not to say that that will happen, but the 38.2 is a very respectable amount of pullback to be given for, again, a healthy bull flag on the daily time frame. Just thought I should point that out as well for consistency's sake. Let's go back over to the IWM, round out our broad market here. It's not really back over, but we're on the IWM now. Certainly looking at this as an overall range. Again, we have it split into thirds nicely. This has sort of been the magnet at 222.50, falling away from that today, sort of caught up in the midpoint now. We would call that number 2. Up here could be number 1, and down below is number 3. If we're in number 2, it supports a neutral theory in the market here, not really aggressive risk on or risk off. We know that if we start to take out 208, that's where, again, really big red flags start to be thrown in our marketplace for a risk off environment, indicating that, yeah, maybe the S&P and the QQQ actually are going to come in a little bit more aggressive than we think. So 208 is still the number to watch in your IWM, definitely moving away from the upper range that we were looking at in the past. Let's go quickly through our core list of companies now, then I'll give you those 2 extra trade ideas here. Apple firmly breaking down underneath the support trend line. The next major area to pay attention to is, again, from right around in here where that volatility was at 172.50. If we come into it and start to form a higher low, so be on the lookout for hammer candles that print, indecision doji candles that print down here, then fantastic. We are technically still in an uptrend. We know we have lows, lows, higher lows, higher lows. That would be a beautiful higher low here, just pulling back a little bit more aggressively from those all-time highs. Apple's been amazing over the past couple of months, so a little bit of consolidation, sideways action over the earlier stages of 2022 would be fine. Maybe we get something out of earnings here, which kicks off a directional move. Next up, we have Netflix. Looking at this one, big relative weakness. It's been this way for a while. In the weekly watch list, we discussed the fact that, hey, there's probably a short underneath 605 to here, and then after we resolve this range, the short is from here to here. Looks like we're almost getting that all in one fell swoop. Now, the saving grace for Netflix right now is the 200 SMA, the green line, so I wouldn't be looking to chase this short as of right now, especially given that we're 1, 2, 3, 4, 5 days down in a row, aggressive days down. Again, to me, I wouldn't be surprised to see a little bit of lift here. Watch out for the resistance resistance trend line. Maybe there's a reshort at that or on the back test of the breakdown point here at 584.50, but I wouldn't try to chase it short at this point in time. If it does continue without you, that's fine. I would wait and see if we get a dead cat bounce out of 555 roughly, noting the importance of that level if I scrunch up the chart. Big area of historic resistance here, as well as here and here. So that's really the next downside target to be paying attention to. Next up, we have Tesla. This one's been all over the place. Big breakout on Monday, regardless of the sort of weakness in tech, and now firmly pulling back a little bit more aggressively. But what I would point out is that we've just filled the gap, right? If we think about this as a bull flag, again, breakout should have technically taken us up towards those highs, but pulling back, repairing the structure underneath, the gap has been filled now. That's a healthy thing in terms of structure. It's not, obviously healthy in terms of trying to make those highs, but nonetheless, the structure has been repaired. Our levels are okay here. Ideally, we just find some support around the 50 SMA and this horizontal area here around 1065. That's been a big level in Tesla for the past little while as this consolidation has been happening in here, lows, then resistance here, flag lows right in here. So we'll see if this supports. If it does, then fantastic. What we have is a break, retest, find support. We would look for an equal high to be set up around 1202. For you longer term guys, if we break down underneath 1065, your line in the sand is at 1000. We know that because it was support from the low end of the range here, ultimately fake breakdown with this movement there. Anything back underneath 1000, I would be a little bit more concerned that we move into the dominant trend line here, closer to 880. And again, that's not a bearish call. I do think that we technically find some support in here, or at least just go sideways. It's not going to be a straight shot lower. So that's what I'm thinking about inside of Tesla. Next up, we have Alibaba, the only green name on our list here, but nonetheless, sort of a failed breakout of the most recent bull flag. If you look at it like this, there was kind of the flag. We talked about this over on the secondary channel yesterday. Started to look fairly good, but ultimately that upper wick on the daily closed back down underneath the high of the flag here, which is fairly concerning. So I wouldn't really be looking for longs, noting this fake break here. I would actually start to look for shorts underneath this 115.85, noting that you probably got some excited investors long in here, thinking that it was going to be the turn. Those people are going to be very disappointed if we start breaking down underneath those 2-day lows. I do think that that could cause a little bit of a flush into this 110 area right here. Next up, we have Facebook. Again, big move to the downside here, big relative weakness, kind of like Netflix. And this is, it's been a very hard chart to read in terms of direction. We know that we've had this kind of range in here. It's been all over the place. It was in the upper third. Now it's kind of at the lower third level right here. So to me, direction's not abundantly clear. There's probably a 50-50 shot that it bounces off of this level or breaks right down through it. In either instance, we know we have targets. There's technically a trade that could unfold here at the 323 quarter. If we start bouncing, it's about the resistance trend line once again. Yes, we did violate it technically in here, but notice that we also have these sort of areas in here coming from the Tuesday low, right? It's also the daily 50 SMA. So again, the dead cat might take us for something like that. 332s to the downside. If it breaks, again, just like Netflix, I wouldn't really want to chase it short right now, but on a reattempt, so let's say it does a lower high, reattempt here, then boom, your short is into the lows from this area around 310. So that's Facebook in a nutshell. Next up, we have NVIDIA. Again, relative weakness in this name, coming back down towards the gap. We know that this is a difficult short to pull off because of this structure in here. I would be patient. I would watch for a move into this, some sort of lower high. And again, a reattempt around this opens the door for the move into 250. So it's not necessarily a short right now, but watch out for either acceptance, so just sideways activity in here, then a breakdown, or just a clean lower high, right? Something that looks like that, reattempt, boom. We talked about the 250 target. The only way to get bullish again in NVIDIA is probably if it can recapture the 50 SMA to make a move towards the midpoint of the range, this big interaction point closer to 310. Next up, we have Microsoft. And this one is also sitting right on top of a gap. It's moved essentially more than 100% of the move like this. So to me, this is definitely not a candidate to be chasing short right now. Sure, could it collapse a little bit lower? Yeah, but I do think that the odds, again, the fact that we've retraced 100% of this move here, merit a little bit of a dead cat bounce. Now, quite simply put, your lower high in an ideal world is at 325, 324.30, coming from these equal sets of lows from right in here, then flipped resistance. So if that happens and we start turning around, sure, definitely retarget the gap and then look for the gap to fill. From 316, we'll call it, down to 312.50. That's a very valid setup here inside of Microsoft, given the fact that we've retraced 100% of the move. Again, I just would not advise a chasing short as the chart is positioned right about now. Let's wrap up our core list here with Amazon. And this one's also breaking down underneath a very important level, that 3,300. You can see that we even had support above that coming from these lows, these 2-day lows as well. Just overall not looking great inside of Amazon. So as and if this firmly accepts underneath 3,300, then what we're looking for is the rotation into 3,176. Now, it's probably not going to get there in one day, but what I would say is if we start closing dojis underneath, if we just fail to get back up and over that 3,300 for the next couple of days, then yeah, the rotation's likely on to the bottom point here, 3176, as we mentioned. On any sort of lower highs, look at the resistance trend line. It's been acting for quite some time now, so I would watch out for that as a sort of valid area to target on any sort of dead cat bounce here. So those are our core list of companies in a nutshell. The next two trade ideas are going to be on Lucid, LCID, and this is a bearish trade idea. And the next one's going to be on Coinbase. We'll get to that in a second here, but this is really just consolidating in a nice range. I love these setups because there are so many things you can do with it. The first thing you would look for is, because we're at the bottom end, we have opportunity for a breakdown. If it happens, we're looking for this little area of support here at 3310. That could certainly be a day trade. Anything further than that is all about 28, the whole number. That's the breakdown. The other trade that you could take at the low end here, if you really believe in Lucid and the market may be supporting the theory for a bounce, then look for mean reversion, and your target's probably going to be here, the midpoint of the range, closer to 40. So those are two trade ideas. The other ones that we can always employ with a range would be something like this. Let's say it starts to go and then it comes back up, right? What do we have? A look below and fail. You stop out of the short trade, you flip long because you know that the target should be the top end of the range here at 42.62. So there's just a number of ideas that come from these tight areas of balance here. There's a number of rules we can put into place. Lucid's definitely one to keep watching. Next up, as we mentioned, we have Coinbase. COIN is going to be your ticker there. And this one's actually a short trade idea, noting, again, we've talked about this theory of 100% retracement, right? Here you go. Here's your 100% retracement. Here's a clean lower high off of a structural area from in the past at this 280. And now we're coming back down into the support trend line. Generally speaking, you do not buy support trend lines on the second touch after a lower high. So to me, it would be very, it would seem to me that this could break down for a move into the next daily support. And that would be here, giving us about a $10 range to play with, right? Today's lows, this little breakdown point is very close to being about a $10 range. And again, if you're trading options, that's plenty to move through to get a very, very decent sized move. And you can see that when Coinbase falls, it has some pretty significant red days, right? So it could easily travel that distance over the course of a morning, over the course of a day and a half, even 2 days if it took to get there. Definitely something to watch out for here inside of Coinbase. That's ultimately going to wrap up the video today. If you enjoyed it or learned anything new, let me know in the comments section or by giving the video a thumbs up. Don't forget our secondary channel is linked down below in the description, where we do 10 to 12 video ideas a day. And with all of that being said, I wish you all a green trading week.